underwriting process. The old VA guarantee loans were receivable by non-veterans. There's still some out there. They haven't been paid off as yet. And it can be assumed by non-veterans if there is no do and save clause in the mortgage contract. So FHA, these are the conditions: the maximum loan by county, and the LTV is 96.5%. Do not forget the loan to value ratio. The maximum loan to value ratio is 96.5%. The minimum down payment is 3.5%. And the insurance that has to be paid, mortgage insurance premium, know the prefix, MIP, because they will use prefixes in your exam. And they will put those prefixes like MIP, PMI, FDIC, FHA, FLMNC, or FNMA. And you need to learn your prefix, because if you don't, you may end up using your own F words. You don't want that. You don't want to have that WTF moment. And you know what WTF stands for? It's welcome to Florida. It's a 203B program.
What was the percentage that you said again?
What's that?
What was the percentage?
Which one? For the at 96.5%?
Yeah.
LTV. 203B, single family residential, underwriting up to 4 units. 234C for condominiums. The 245 is for graduated payment mortgages. And the loan program that may result in negative amortization under the FHA loan program is the 245 program. That may result in negative amortization. Know the term, because sometimes the payments are not enough to pay the interest. Therefore, the principal payment is going to go up by every payment that's made. So the FHA program that may result in negative amortization is called a graduated payment mortgage. There is no prepayment penalties under this type of loan program. The loan can be repaid without any penalties. The VA guarantee loan are for veterans only. There is a maximum guarantee. So change the amount in your book. I think your book has the old guarantee that was passed last year. The new guarantee is $121,087.50. The new VA guarantee loan program is $121,087.50. There is no maximum loan amount, but the lender will lend up to 4 times the guarantee without no down payment. So the lender says, I'm going to lend you $484,350 and no down payment. That's the reason the lender will lend up to that amount and doesn't require down payment, because it's 4 times the guarantee. Where the lender says, well, I'm getting 4 times the guarantee, therefore you don't require to put any money down. So if you do not pay back the money, well, I get my money. And that's the reason they will not require a down payment. So if anything over that amount, the lender would require the veteran puts down 25%. Progress in your exam, anything over the $484,350, the lender will request the veteran puts down 25% of the excess. Then you'll get the amount exceeding the maximum loan amount based on the guarantee. So the maximum loan amount, let's take this out here, there's no guarantee here. This words have to be taken out. The maximum loan amount the lender will lend with no down payment is $484,350. So guarantee is $121,087.50. Has to be for the veteran's principal residence. There's a funding fee that may be charged, 0.5% to 3%, and discount points can be paid by anyone. So this is a type of loan program that does not require a down payment if the veteran qualifies for the loan. And the ratio is 41% total obligation ratio. There is no housing expense ratio when it comes to this loan. Question: which of the following loans does not require a down payment? There's also other financing. You have a purchase money mortgage. A purchase money mortgage basically is called seller financing. That creates a vendor's lien. A vendor's lien comes from a purchase money mortgage. We discussed that this morning. A vendor's lien is a result of a purchase money mortgage, and the reason it's called a purchase money mortgage is that no money change hands. There is no physical money changing hands. It's where the seller says, I'm going to take a mortgage, a promissory note for the amount of the proceeds of the sale that I'm going to forego, and you can secure this note by a mortgage. That's what it's called a purchase money mortgage. And it is a result of seller financing. That's the only type of mortgage that is a result of seller financing. Purchase money mortgage. And it creates a vendor's lien. So know the concept. Purchase money mortgage is always seller financing, and it's always a vendor's lien on the property. Then we have a blanket mortgage. A blanket mortgage is the type of loan that covers more than one property. More than one property as security for the note. So a blanket mortgage usually contains a partial release clause, where the lender is going to release the lien on the parcel that's sold, and the lien on the remaining parcels remain intact until the last parcel is sold, and the lender is fully repaid. Package mortgage, real and personal property, is pledged as security for the loan. Pledging the home, pledging all the furniture and appliances in the home. Reverse annuity, only available to elderly homeowners. And the homeowner has to be 62 years of age or older, must have equity in the home, and the lender is going to give them money for equity in the home. And the date the loan comes due is the date of death. So when the homeowner passes away on that date, the loan becomes due. That's why it's called a reverse annuity. And the loan is repaid on the date of death. That means whatever they have to do with the home to pay back the loan, that's what's going to happen. That's what it's called a reverse annuity. The owner gets money in return for equity. Sign the promissory note, it's going to be paid on the day the big guy calls my name. It's a line of credit against the property. That's why it's called a reverse annuity mortgage, or reverse mortgage. I'm giving you the right to put a lien on the equity in my home in return for money. Yeah. There you lie, comes to. Loan covering several parcels of land is called. So if several parcels, it's called blanket. In order to reduce initial outlay involved in the purchase of home, personal property is included as a package mortgage. Once you include personal property as part of the length of the loan, it's called a package mortgage. When the lender underwrites a loan, the lender is going to decide the repayment period. How the loan is going to be repaid. Well, there's three types of repayment methods the lender is going to require. It depends on the loan program. And the first of the three is called a term loan. A term loan is an interest-only loan. And there are two types of term loans. One of the first of the two is called a construction loan. A construction loan is a type of term loan where the lender approves the loan, but the lender only disburses the loan by installments. And as the loan basically, as the property being improved, the lender will continue to advance the money. And the borrower pays interest on the amount that is advanced. That's why it's called a term loan, but it's given by installments. And if you give it by installments, it's called a construction loan. A true term loan is where the lender advances the full amount on the day of funding, and the interest payments are due on a monthly basis. Only interest only. And it has a balloon payment on a promissory note. And the balloon payment is whatever the maturity date is. And then the borrower has to pay that full amount that was borrowed. In the meantime, they're making interest-only payments. Then the lender can choose an amortizing loan. There are two types of amortizing loan. The first of the two is called fully amortizing or partially amortizing. Know the difference. Fully amortizing loans is where the payments amortize the loan over the term, and there is no balloon payment. So a fully amortizing loan, you have principal and interest payments over the term of the loan. At the end of the term, the final payment will put the loan amount to zero, whatever that time is. A partial amortizing loan is where the payments are, the loan is amortized longer than the maturity date. And in a partial amortizing loan, there is a balloon payment. And that's the difference between fully and partially. Partially has a balloon payment, fully has no balloon payment. The big differences between the two. Principal and interest payments are made, but one has a balloon payment and one does not. Then we have an adjustable rate mortgage. An ARM loan, as it's called, ICE prefix. All you need to know the components of an ARM loan. And the two components are the index and the margin. The index comes in the marketplace, when the lender chooses the index and the lender adds their profit. His profit is known as a margin or a spread. And the rate that comes from the marketplace plus the profit will be the interest rate on the note. The component that goes up and down to make it an ARM loan is called the index. The index goes up and down, depends on the interaction in the marketplace. The profit or margin or spread remains the same. So the component that changes is called the index. The component does not change is called the margin. So that's all you need to know for a ARM loan or adjustable rate mortgage. Question? Interest-only loan is called term. That's where interest-only payments are made and there's a balloon payment on the date of maturity. There are other forms of financing, and one of the other forms of financing is called contract for deed, also known as a land contract, also known as an installment sales contract. Word means the same in the exam. Contract for deed is owner financing, where the owner is taking installment payments to the buyer. And the owner, seller, retains legal title to the property, and the buyer gets equitable title to the property. And when the last payment is made on that installment sale method, the buyer will get legal title to the property. That's what's called contract for deed. The buyer has a contract to get the deed. When the last installment payment is made, the seller retains legal title in the meantime. The buyer gets equitable title. All the rights of ownership, but on an equitable basis. That's why this type of contract is prepared by an attorney, and it should be recorded for the buyer to homestead rights to protect the buyer's financial interest in the property. The marketplace of money is based on the concept of intermediation and disintermediation. Know the concept. Intermediation means money goes into the system. Money goes into the system through the financial intermediaries, and the supply of money increases in the marketplace. Disintermediation means money exits the system, and the supply of money decreases in the marketplace. And that's how you have the interest rates were formed by intermediation and disintermediation of the marketplace. Marketplace for money. In order to control the supply of money in the marketplace in this country, that responsibility is given to the Federal Reserve Board. And the Federal Reserve has a system where the money flows in and the money flows out. And they are economic tools that the Federal Reserve uses to do so. And these are the economic tools that the Federal Reserve uses and the effect it has in the marketplace. Well, the most effective tool that the Federal Reserve has to control the money supply is called the open market operations. The most effective tool. That means they use it every day. They're in the marketplace buying and selling the US government paper on a regular basis. And that's how they control the money supply. If they want to put money in, they will buy the government paper. That money goes in and supply increases. If they want to shrink the money supply, they'll sell the government paper and take the money out of the marketplace. And that's the most effective tool they use to control the money supply. The least effective tool is raising and lowering the discount rate. Well, the discount rate basically is a rate that the Federal Reserve Bank charges member banks for more money from the Federal Reserve. It's up to the banks to go to more money. You can't force them to do it, But if they want to do it, they can. And the rate they pay to the Federal Reserve is called a discount rate. And they can go and lend it to the consumer by putting a margin. Well, it's a least effective tool. Depends on the lender. If the lender wants money, and they'll go to the Federal Reserve discount window to borrow the money. The most abrupt tool is called a reserve requirement. The most abrupt. That means when they exercise this economic tool, the market reacts immediately. The reserve requirement is a requirement that every bank has to put aside in reserve a percentage of all depositors' money. Has to be in reserve. And they have to comply every day. Because every day they have to report to the Federal Reserve how much they have in reserve. And it's a requirement. Every single day at the end of banking day, they have to send a report to the Federal Reserve on how much money they have in reserve. And it must equal the percentage the Federal Reserve dictates. And if the Federal Reserve changed that reserve requirement today, by the end of business today, that bank has to comply. And that's the most abrupt tool. That means they trigger that, the market has to react immediately where the money is going to come from to put in reserve. So these are the three tools that the Federal Reserve uses to control the money supply. Make note of the open market operations, the most effective tool, which is your state exam, based on my Central Intelligence people. So, called the open market operations, the most effective tool being in the marketplace. Question. When the Federal Reserve orders financial institutions to increase their reserves, it serves to? Well, you have to. Basically, more money has to stay in the bank, less money goes out in the street. And that's the most abrupt tool they use to do so. That means it shrinks the marketplace immediately. U.S. monetary policy is controlled by the reserve system. That's a system where the money flows in, money flows out. And you have these economic tools they use to do so. Then we have this law. It's called the Financial Institution Reform, Recovery and Enforcement Act. It was passed by Congress as a result of a financial crisis we had in the 80s. And Congress decided to put some regulatory bodies in place to make sure it doesn't happen again. And one of the regulatory bodies this law and Congress decided to create is called the Office of the Controller of Currency, also known as the OCC. And what the OCC does is charter and regulate commercial banks. Those banks that are in the banking system that are good in lending construction loans and short-term credit and lines of credit. And now they're involved in long-term lending. It's called the Office of the Controller of Currency. And they also expand the mandate for this insurance company called the Federal Deposit Insurance Corporation. That was formed in the 1930s to insure depositors' money in these banks. And you have the insurance up to $250,000 per account. Well, they have these two insurance funds that insure your account, depending on which bank you're using. If you're using a commercial bank, you have the bank insurance fund. If you're using a savings association, you have the Savings Association Insurance Fund. Two funds under the FDIC that insures the depositors' money in institutions that you're banking with. So that's the law that basically expands the mandate of the FDIC and create the Office of the Controller of Currency to make sure that these institutions are regulated and also they're insured. We don't have a banking crisis like we did in the 80s. In the marketplace, there are two types of lenders and there are two types of marketplaces. The first marketplace is called the primary market, and the primary market is where the primary lenders function and is accessible by the consumers. That's where loans are created, loans are serviced, and that's where the consumer goes to get money. And there are players in this marketplace, and the players are, you have your commercial banks. These are banks that are national in nature. You have your savings association. These are banks that are federal in nature. You have your life insurance companies where we go to get large sums of money for major projects. They do not lend it to small people, they lend it to them for major projects, and they're not controlled by the federal government. They're state controlled. Then you have your mortgage bankers that are licensed to lend money. They have money to lend, they get money from sources that they have gathered over time, and they will lend those monies and they will service the loans, just like any other bank does. They have people's money to lend, and they will service and they charge you a fee for doing so. Then you have your commercial, your credit unions and your mutual savings banks, and so on. So the federal government does not regulate the lending policies of which are the following. The LICs are state regulated, not federally regulated. Federal government has no say. That's why you have insurance companies, which are the following. It's not a primary lender. Yeah, mortgage broker doesn't have any money. He's broke. Mortgage broker, just like real estate brokers. Brokers, you're broke. Financial institution named first national. The national banks are commercial in nature. Federal banks are savings association are federal in nature. So we have your commercial banks, they're always national, they're across the country. And they have every state they work out of. You have your federal institutions, they have the savings association. When the primary market exhausts all their monies, letting it to the consumer, they have to raise more money. And raising more money means they have to go and sell something. So what does the something that the primary market lenders has that is very valuable? Mortgages. Not mortgages. Mortgages have no amount. What do they have? Come on guys, we talked about it earlier. They have the promissory notes. That's a silver item. It has an amount, has an interest rate, it has a monthly payment. And not also, it's a note, it's secured by a mortgage. The mortgage secures a note, it's a highly secured note. Therefore, it's very, very valuable. So what the primary lenders will do, they'll package these notes and all these mortgages that secure these notes, and they go to the secondary market and say, hey, I have some mortgages, right? That secures notes, and I want to send you the note and assign the mortgage. How much you pay me for it? Well, there's only 3 of them. 3 of these agencies you need to be familiar with. There are a couple more, but these are the ones that you need to be familiar with. And 2 of them are governmental agencies, and 1 is a governmental department. So, the governmental agency that you need to be familiar with, according to my CIA friend, is the Federal National Mortgage Association. It's called Fannie Mae. Fannie Mae was established by the government in the 1930s just to buy FHA loans. That's what Fannie does. And Fannie is doing not only FHA loans, buying private loans and all those loans out there. That's what Fannie is doing today. It's a governmental agency. The governmental department is called Ginnie Mae, Government National Mortgage Association. It's part of HUD. And Ginnie not only buy those notes and take assignments of mortgages, they issue guarantees because of the guarantee of the government. Fannie and Freddie can't issue guarantees, the government can. And that's why Ginnie is there to issue the guarantees. Then we have Freddie Mac, Federal Home Loan Mortgage Corporation, was formed specifically for the savings associations. And that's where the savings association go to sell their notes and sign their mortgages. That's called Freddie Mac. So you have these 3, 2 are governmental agencies, the ones that start with F, and 1 is the governmental department, the one that start with a G. So you can identify when they ask you the question, which one is a governmental agency and which one is a governmental department. The one that's with F is an agency, it's created by the government. The one that's with a G is already a governmental department, it's part of HUD. Savings Association, look to what federal agency to sell their mortgages. That's Freddie Mac. Savings Association goes to Freddie and says, look, I have these notes, I sign and I have these mortgages to secure the notes. How much you gonna give me to me? What money I'm gonna get? All the following are ways the Federal Reserve used to control the money supply, except change this company, except fiscal policy. Who does that? routine fiscal policy in this country.
Pero,
Come on, guys, you know this stuff. You'll do it next year, again. Your Congress.
Congress.
Your Congress, the people you elect, they're the ones that spend your money. You know that. That's what you elect them to do, spend your money. It's called appropriations. That's where they go and do it all the time. They change your tax codes, they spend your money, and all these things they do in Congress. That's fiscal policy. Congress is responsible for the spending of the money that they created through taxes. You give them the right to do so because you elect them. Freddie Mac is responsible for which of the following? When you're in doubt, exactly. Wanted to be to swag a question, right? When in doubt, choose all the above, or choose the longest answer. Right? Use the longest answer. It helps. They have to give you everything. So, all the above or the longest answer. That's another way of swagging when you go to an exam. Which of the following is not involved in a secondary mortgage market? Exactly. You have the two F's and the G. They're all government or financial or agencies. That's the fund. It's called Savings Association Insurance Fund. What's the function of a secondary lender as opposed to a primary lender? That's what the secondary lender does. They don't provide money to you, the consumer. They basically provide money to the primary lenders by buying their notes and taking assignment of their mortgages. Then we have these two federal laws that you need to be familiar with. One is called the Truth in Lending Law. And truth in lending has to do